Hi, and welcome to this special edition of the Macro Show. I'm your host, Steven Van Metre, and today we're going to go over the quarterly report from Hoisington Investment Management. Now, what's really special about this report is it's written by Dr. Lacey Hunt, someone I'm a huge fan of, and someone who the industry, people who are bond bullish or interested in the bond market, they read this report. And in fact, I often read it 2 or 3 times, and I save every one of them to go back for reference. So let's go through this report and see what we can learn about the bond market and monetary policy from the expert, Dr. Lacey Hunt. Now, if you're not familiar with where to get the report, I'll link to their website in the description below. Let's get started. So they're still bullish. And Hoisington is still bullish, and let's start. And now some of you said, well, I don't need you to read to me, and others have said, hey, you can read to me anytime you want. So let's read through the pieces of the report and see what we can learn. Investing in a 30-year U.S. Treasury bond at a paltry yield of 2.4% on December 31st, 2019 appeared to be a poor investment choice, particularly since it was the lowest year-end yield since the inception of the 30-year bond in 1977. However, in a short 12 months, the 30-year U.S. Treasury realized a 20% return compared with an 18.4% return in the S&P 500 and a 7.5% return from the Bloomberg Barclays Aggregate Bond Index, which is pretty impressive, as we've already talked about. Now, he goes on to say, interest rates will rise through 2021. This is the expectation of market forecasters, owing to the expectation that additional fiscal stimulus coupled with an easy monetary policy will create an inflationary cocktail as pandemic-related shutdowns lessen. Now, keep in mind, even though it's not in this report, there have been 5 different direct-to-consumer fiscal attempts in the history of I say attempts, we actually did them in the history of the United States, and they've had almost negligible effect on the economy. I mean, so little that they were deemed entirely worthless, but yet, the market forecasters are always bullish on money going directly to consumers. Let's continue on with the report, and he goes on to say, that his firm maintains a bullish stance on long U.S. Treasury yields. Or the essence of the decision to maintain a bullish stance on long Treasury yields is not whether rates can rise, since it happens transitorily every year, but whether they can stay elevated. Provided there are no major changes by Congress to the Federal Reserve Act, we believe it's prudent to expect that long-dated U.S. Treasury rates will eventually gravitate to lower yields as inflation continues to recede. And he has a lot of reasons for this. First, the massive void in economic activity and disruption of wealth created by the virus and related shutdowns of businesses in the U.S. and abroad will take years to fill. Something that we've talked about on the Macro Show is these businesses are not coming back overnight. Once they've failed, it will take years to bring them back in the demand for them. Second, U.S. fiscal multipliers are generally negative, rendering much of the government spending counterproductive in terms of stimulating economic growth. Third, monetary policy becomes much less impactful since the debt overhang, something we've talked about, was massive before the pandemic and is now even worse, not just in the United States, but all parts of the world. So he then goes on to describe the void. And I'll leave this first part because we've discussed the unemployment and the declining number of jobs in the Macro Show. But he goes on to say down here, the gap between the unemployed and available jobs is wide. And this is going to be a problem when the economy does eventually start to reopen. So let's look at some comments from David Rosenberg that I shared with you on the Macro Show. Is government benefits now account for 20% of total personal incomes. And what we're seeing is just the damage from the pandemic. 1 in 4 households haven't been able to meet their monthly bills since March. 1 in 15 homeowners in some sort of loan forbearance relief plan. 75% of government stimulus went to debt pay down and savings. And 1 in 3 households dipped into savings or retirement accounts over the past year. And 1 in 6 has borrowed from a family or friend to cover bills. So this is a huge, huge void. Continue on, the National Multifamily Housing Association found that over 3/4 of households made full or partial rent payments for the month ending in December 6th, meaning there was a little less than 1/4 that didn't. That's obviously a problem when you think about future demand and pent-up demand. There are people that are not able to make their bills, and yet the market is interpreting as everyone has money and lots of it and is ready to go spend. That's definitely not the case for everyone. One sector that I think is going to, that my heart really goes out to is the restaurant association or restaurateurs, because they already work on thin margins to begin with, and this has not been good. The National Restaurant Association thinks that more than 500,000 restaurants are in free fall. And the same might be said for other entertainment venues, service industries. The severity of the downturn has decimated many small businesses, and they may not survive in their former state. It is also the case for office buildings, shopping centers, convention facilities, and airlines. All are going to take major hits that will take years to come back. Now, he talks about GDP measuring new output, but has no capability of subtracting from the output measure the destruction of wealth caused by the pandemic and the economic shutdown response. So, when you hear whether it's politicians or President-elect Joe Biden talk about stimulus is going to bring all this GDP growth, keep in mind, and this is, I'm not picking on the new administration at all. This is just general. This is true that it does not factor the loss of output already. So achieving level of pre-crisis activity will in fact require years, owing to the wealth destruction. Now, he cites a couple of books which you can check out if you want to look them up. But it goes on to say the essence of economics consists of looking not merely at the immediate, but at the longer term effects of any act or policy. It consists of tracing the consequences of that policy not merely for one group, but for all groups. The component of this argument was the fallacy of the broken window. If a brick is thrown through the window of the bakery and it breaks, the baker will have to replace the window. In the process, GDP will be boosted. This is correct. However, the wealth of the baker is reduced because the baker has to reduce other assets or components of their wealth to replace the window, and thus the economy is worse off than if no damage was incurred. Therefore, if this were not true, then economic prosperity could be achieved by breaking each other's window. The GDP measure fails to register this loss of wealth. Let's look at government multipliers now. And this is where it gets interesting to me. This is the part of his reports where I really get the most value. During the fiscal year ending 2020, the federal government ran a deficit of $3.13 trillion, nearly 218% above the $948 billion deficit recorded for fiscal year 2019. This percent increase is nearly identical to the deficit increase in 2009 of a 208% as a response to the global financial crisis. And of course, as we probably already know, post-election estimates for the 2021 deficit is centered around $3.1 trillion, which is staggering. Now, there are always, concerns about future inflation. And let me find where that is. The size of the outlays have created some concern regarding future inflation. But the macroeconomic effects of fiscal stimuli or fiscal multipliers is really where we need to go next. So the macroeconomic impact of the expenditure shock depends on four key country characteristics. First, industrial countries respond with a positive multiplier. Second, economies operating under flexible exchange rates have a negative multiplier. Third, countries that are open to trade have a negative multiplier. And fourth, the government spending multiplier is sharply negative in highly indebted countries. They point out that the definition of highly indebted is a central government debt exceeding 60% of GDP, a condition that is met by most major economies in the world. And not only that, but the composition of those expenditures play an important role in fiscal stimulus. The last point regarding the type of expenditures is important, suggesting that not all government is created equal, or government spending is created equal. Investment in physical infrastructure, health, education, and other similar programs can provide a long-term boost to GDP according to their work. And we'll see that in the chart here. Gross federal debt as percent of GDP is way off the charts, suggesting that, again, that multiplier from the fiscal effects will be negligible at best. So is our conclusion that the U.S. fiscal multipliers are in fact negative for non-investment type of spending? First, the United States is obviously a developed country that is positive. The U.S., however, meets all of the other three constraining features. The U.S. operates with flexible exchange rates, is a relatively open economy with respect to trade, and is highly indebted. Note that the U.S. government as a debt to percent of GDP is not 60%, but 127%, and therefore non-investment expenditure multipliers appear to be negative. This indicates that sustained strong macroeconomic response from large federal government deficits should not be expected. Sizable debt financed federal fiscal operations in 2009 and 18 produced only transitory spurts of economic activity, as we already know. Now, also, these failed fiscal efforts have occurred under the leadership of both major political parties. This indicates that weak multipliers are not the result of political leadership, but the nature of debt-financed operations. Government funding is derived from taxing and borrowing from citizens. This process reduces the resources of the private sector, which provides productivity growth, expanding in economic pie. This transfer of resources to the federal sector can result in a misallocation of resources, reducing the overall productivity and growth for the entire economic system. Again, this is something we have talked about on the macro show, is that all of this debt just takes away from the potential of the private economy, and how you can see this is exactly what Dr. Hunt is writing about, saying, look, this is a problem. Let's continue on to the debt drag. Total public and private debt in the United States rose last year to 405.9% of GDP, up from 365.9% of GDP in 2019. If we go on a little bit lower here, previous studies have indicated that the productivity of debt tends to decline with the overuse of that particular factor of production. When debt capital, like any other factor of production, is overused, its marginal revenue product declines. This serves as a persistent drag on economic activity that restrains growth despite the best efforts of monetary and fiscal policy. The decline in marginal revenue productivity of debt due to the pandemic must now operate with even weaker demographics around the world. The pandemic resulted in considerably lower marriage and birth rates, which will have negative long-term consequences for domestic and global growth. Based on universally applicable production function, the capability of achieving historical rates of economic growth will be even more difficult in the years ahead. And here's that one chart that I cannot replicate, is the marginal revenue product of debt. And you can see this is the growth we get out of every dollar that's borrowed. Now, this is pretty good compared to the rest of the world, but it is absolutely terrible. This is why more borrowing doesn't lead to more growth. And you can see back in the 60s and 70s, the government could borrow and get growth out of it. Today, it gets very little for that. As we go into the monetary policy section, we're going to skip down here to the bottom. However, the lower rate structure reduces the revenue and income of many financial intermediaries. He's referring to banks and people refinancing their debt to lower interest rates. Maybe this is a reason why the banks are eager to do QE, because they can make money doing that. He talks about the velocity of money fell to 17.7% in 2020. You can see in his chart going back to 1900, that's the lowest rate since 1946, and likely that it is to head lower. And with velocity falling, funds available for financial investment surge, as did prices in many asset markets. Idle money found a home. The drop in velocity, however, is consistent with the sharp decline in the marginal revenue product of debt and suggests no long-lasting inflation consequences from the 2020 surge in the M2. And to wrap this up, in sum, considering economic destruction placed on individuals and small businesses by the virus and its resultant shutdowns, the fact that fiscal expenditures have a negative multiplier on macroeconomic conditions, the debilitating impact on growth of excessive debt, and the restriction of the zero bound on monetary stimulus mean can't go lower on the federal funds rate than zero. A secular inflation cycle is not at hand. Since inflation is a primary determinant of the yield on long-dated U.S. government debt, it remains our judgment that the bull run in 30-year U.S. Treasuries is continuing. So as I mentioned before, I'll link this into the description below so you can go back and look at some of his other reports if you want. And again, required reading. Dr. Hunt is absolutely brilliant, and he brings monetary policy and the bond market together with facts and math, and I think that is really powerful. This is why he is one of the very few people that I religiously follow in the bond market, and I hope that you will as well. And we'll look forward to next quarter where we'll go over his future reports, since this one was pretty light. I'm Steve Van Metre. Thanks for watching. We'll see you again soon. The content of this video provides educational information only. Is not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation to buy or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity and opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.